So I want to kick off today's deep dive with a bit of a challenge, like a genuine uh, psychological litmus test for everyone listening right now.
Okay, I like where this is going.
Yeah, so when I say the word wealth, what is the very first high-definition image that flashes in your brain? And you have to be honest.
Right.
Is it um, a yacht docked in Monaco? Is it a sprawling mansion with 12 bedrooms and a fountain in the driveway? Or is it simply waking up on a Tuesday morning and realizing you don't have to set an alarm clock?
It's a really fascinating distinction, isn't it? Because we are culturally bombarded, really, to see wealth as the accumulation of objects.
Shiny, expensive, visible things.
Exactly.
Yeah.
But if we dig into the stack of research we have today, specifically looking at the philosophy of Morgan Housel and his work on the psychology of money, the definition shifts dramatically.
Completely.
It shifts from what can I buy to how can I live?
And that is exactly what we're unpacking in this deep dive. We've got a lot of material here focusing on Housel's work, and the mission for today is actually pretty specific.
Very specific.
We are not talking about stock tips. We aren't going to debate interest rates or, the future of crypto. We are going to look at redefining the entire goal of investing.
Right. Shifting away from just trying to get rich in that traditional material sense.
Yeah, to gaining freedom. That's the core of it.
And to do that, we have to look at two main pillars from the source material. First, we really need to understand why controlling your time is actually the highest form of wealth.
Higher than any bank balance.
Oh, absolutely. Higher than any number on a screen. And second, we have to look at strategy. Specifically, why being reasonable with your money is infinitely smarter than being perfectly rational.
I love that second point because it sounds so counterintuitive. I mean, we're always told to be rational, right?
To be cold, calculating logic machines, yeah.
Exactly. But before we get there, let's tackle the big one, the time concept. Because honestly, if money isn't for buying better stuff, what are we actually doing with it?
Well, let's look at Housel's core thesis here. He basically argues that the highest form of wealth is the ability to control your time.
Right.
It's the ability to wake up and say, I can do whatever I want today. It's that autonomy to decide what you do, when you do it, and who you do it with.
So money is really just the tool that buys the control.
Precisely. Money is the mechanism, but time is the asset. And the source material highlights a really common misconception here, which they call the man-in-the-car paradox.
Oh yeah, I really like this part of the notes.
Yeah.
Walk us through that because I think everyone listening has experienced this exact feeling without actually realizing what was happening.
So picture this. You're walking down the street, and you see a guy driving a bright red Ferrari. The engine is roaring. It looks incredible. What do you actually think?
You, you usually think, wow, that's a cool car, or man, I wish I had that car.
Exactly. You rarely look at the driver and think, wow, that guy is cool.
That's so true. You're looking at the object, kind of just imagining yourself in it. You don't actually care about the owner at all.
Right, but the driver thinks he's signaling status. He thinks he's signaling importance. He assumes everyone is looking at him.
When they're really just using him as a prop.
Using his car as a prop for their own fantasies, yeah. Housel's point is that people think they want the yacht or the fancy car to get respect and admiration.
Right.
But what they actually want is the feeling of autonomy and security that they think those objects represent.
Right. The sources mention that what people actually crave, like if you strip away all the ego, are mornings without an alarm.
Yes.
They want the ability to say no to a toxic boss. They want time for health, time for family, or time to work on a creative project without stressing over whether it pays the rent next week.
It's basically about trading mandatory time for optional time. That is the fundamental trade-off of wealth.
Mandatory time being?
Doing things because you have to, usually for someone else's priorities. Whereas optional time is doing things because you actually choose to.
Okay, that makes sense.
The more wealth you have, the more you can shift that balance from mandatory over to optional.
I think this is where a lot of high earners get really trapped, though. I mean, we've all seen the high-powered lawyer or the investment banker who makes an absolute fortune but is completely miserable.
Oh, for sure. That is the autonomy versus status trap. You can have a massive income, let's say $500,000 a year.
Right.
But if you have zero control over your schedule, if you have to be in the office at 6 in the morning and you can't leave until 9 at night, and you have no say in the projects you work on,
You're basically owned by the job.
psychologically, you can feel much poorer than someone making a fraction of your salary who has total flexibility over their day.
That's a heavy realization.
Right.
It really reminds me of that old saying that money buys happiness only to the extent that it buys freedom.
Exactly.
A life where you own your calendar is just more satisfying than a life where you just own more stuff.
Yeah.
But let's try to bring this down to earth for you listening right now, because this all sounds great conceptually, right? Buy freedom, but how do we actually apply this?
Yeah, the practical application.
How do we stop looking at our bank account as just a scoreboard and start seeing it as time inventory?
Well, it starts with the concept of the time buffer. The source material describes savings and investments not as a way to buy things down the road, but as a hedge against the world's demands right now.
Okay, let's unpack that word buffer. Give me a scenario.
Sure, let's say you have a toxic job. Your boss is a total nightmare, the culture is draining you, and you literally dread going in every single day.
Sounds familiar to a lot of people, I'm sure.
Right. Now, if you have zero savings, zero buffer, you are trapped. You are a hostage to that paycheck. You have to stay because the rent is due on the 1st. The world's demands are entirely dictating your life.
But if you have that buffer,
If you have that buffer, you can leave without panic. You can just walk away. That money in the bank isn't a down payment on a Tesla. It's the ability to say, I'm done here, and know you'll be totally fine while you look for something better.
it gives you breathing room.
It allows you to absorb shocks. If a family member gets sick or you have a health issue, you don't have to make crisis decisions. You have essentially purchased a gap between a stimulus and your response.
So we need to completely change the metrics. I love how the expert analysis in our notes suggests rephrasing your financial goals.
Yes, the language matters so much.
Right, because instead of walking around saying, I want to have $1 million,
Yeah.
which is abstract and frankly kind of arbitrary, you change the language to be about time.
Right. You translate the dollars into duration. So instead of saying, I have $50,000 in savings, you say, I have 6 months of freedom saved.
I love that.
Or if I have X amount invested, I can go 12 months without earning a paycheck.
Or even looking at passive income. Instead of, this dividend stock pays me $500 a year, it's this passive income covers 10% of my grocery bill forever.
Exactly. It gives you percentage ownership of your time. If your portfolio covers 50% of your living costs, that means you own 50% of your time.
You only have to work to cover the other half.
Right. And that shift in perspective is incredibly powerful because it makes the goal tangible. It's no longer just a number on a screen. It's literally your life.
The sources also list some really specific autonomy goals that prioritize lifestyle over net worth. One of them that really stood out to me was work 4 days a week by age 45.
Yes.
That just feels so much more actionable than some vague retire at 65 goal.
That's a perfect example of it. Or another one is be able to walk away from any single client. If you're a freelancer or a business owner, that is ultimate power.
Oh, absolutely.
Because if you need every single client to survive, you are a servant to them. You tolerate bad behavior, late payments, scope creep. But if you have the financial buffer to say, this client is toxic, I'm firing them, you have reclaimed your autonomy.
This also deeply changes how we evaluate career opportunities, doesn't it? I mean, usually if someone offers you a raise, you just take it.
Yeah.
That's the default setting in the corporate world. More money equals a better job.
But through the lens of time control, you really have to pause. Housel suggests we view our careers through a lifestyle cost filter.
Lifestyle costs.
Yeah, so if a new job offers a 20% raise, but requires you to be on call on weekends, commute an extra hour a day, and you lose your flexible remote days,
The math looks good, but
mathematically, your income went up. But your wealth in terms of time freedom has totally crashed.
you're essentially selling your freedom for that 20%.
And you might actually be heavily reducing your quality of life by taking the money. It's just a bad trade.
That is such a critical filter to apply. Asking, how much control over my time can I buy and how soon, is a vastly better question than how rich can I get?
It really is. You are investing for the ability to live days that feel self-directed. That is the end game.
Okay, so we've established that freedom is the goal. That's the what. Now we need to talk about the how.
The strategy.
Right. And this is where we get into the strategy part of Housel's philosophy. And honestly, this is where the finance textbooks might get a little angry with us.
Oh, they definitely will. Because traditional finance is absolutely obsessed with being rational.
Rational. I mean, it sounds like a compliment. Who doesn't want to be rational?
In finance, rational has a very specific meaning. It means you maximize expected utility, you optimize every single basis point, you care only about the long-term math.
Right.
You're supposed to act like a cold, calculating machine, an algorithm that never gets scared, never gets greedy, and never loses a wink of sleep.
But we aren't machines.
No, we are wetware. We are biological, emotional creatures.
Yeah.
And Housel's argument, and this is really a hill he dies on, is that aiming for perfectly rational is actually a recipe for failure.
Okay.
Instead, you should aim to be reasonable.
Reasonable beats perfectly rational. Let's break that down. Why does the on-paper optimal strategy fail so often in the real world?
Because it completely ignores the emotional reality of being human. Fear, greed, anxiety, regret. These aren't bugs in the system. They are core features of our psychology.
You can't just spreadsheet them away.
Exactly. You cannot design a financial plan that ignores human emotion.
Can you give us a concrete example of a rational plan that just falls apart?
Sure. Let's look at leverage, or even just a 100% stock portfolio. A textbook will tell you that the optimal strategy for a 30-year-old is to be entirely in stocks, maybe even borrowing money to invest more.
Because historically, stocks yield the highest return over 30 years.
Mathematically, that is completely correct.
It looks great on the spreadsheet. The line just goes up and to the right.
It looks amazing on paper, but then real life happens. The market drops 40% in 3 months.
Right.
And at the exact same time, maybe you lose your job. Or your spouse gets sick. The spreadsheet doesn't know you're panicking. The spreadsheet doesn't know you have cortisol flooding your veins and you haven't slept in a week.
And that's exactly when you sell.
That's when you sell. And you sell at the bottom. You destroy all that long-term compounding because the plan was too fragile. It was optimized for math, but it wasn't optimized for you.
It's the life doesn't equal a spreadsheet rule. Spreadsheets just don't account for how it feels to see your net worth cut in half while you're simultaneously facing a real-life crisis.
Exactly. Optimization often equals fragility. Think about a Formula One car.
Okay.
It is optimized for pure speed. It is an absolute marvel of engineering, but it is incredibly fragile. If it hits a tiny bump on a normal road, it shatters.
Right. It's not made for potholes.
Exactly. Now, a Toyota Camry is reasonable. It's reliable, safe, maybe a bit slower, but it's the one that actually finishes the cross-country road trip without breaking down on the side of the highway.
I really love that analogy. We want a portfolio that acts like a Toyota Camry, not a Formula One car. So if we are optimizing for reasonable, what does that actually look like in a portfolio? Because I feel like listeners might be thinking, okay, so do I just stuff it all under my mattress?
No, not at all. It's about balance. It's about optimizing for sleep and adherence. Adherence is the key word here. Can you stick to the plan when the world feels like it's burning down?
So let's talk about cash. Because inflation hates cash, right?
Cash is king psychologically, even if it's a total pauper mathematically.
Explain that.
A purely rational investor hates cash. Inflation eats it away. It earns very little return. It's a drag on your overall performance.
Right.
But a reasonable investor holds a larger emergency fund than the textbook recommends.
Why, though? If I'm losing 2 or 3% to inflation every year, why hold it?
Because that cash prevents you from selling your long-term assets during a panic. That's the secret. If the market crashes and you have a year of cash sitting in the bank, you don't have to touch your stocks.
You can just let them recover.
Exactly. The cash is irrational in return terms, but it's entirely reasonable because it protects the rest of your wealth. It's not an investment. It's an insurance policy against your own panic.
I really like that framing. It's the price of admission for staying in the game. What about diversification?
Same exact thing. You might accept slightly lower expected returns by diversifying owning things that don't all move up and down together in exchange for a much lower risk of ruin.
Right.
You are trying to avoid that gut-wrenching drawdown that makes you throw your hands up and quit. There's actually a great story in the sources about Harry Markowitz,
Wait, the guy who won the Nobel Prize for modern portfolio theory?
the father of rational investing himself. He literally invented the math on how to optimize a portfolio. But when he was asked how he invested his own money, he didn't use his complex formulas.
What did he do?
He said he simply split his money 50-50 between stocks and bonds.
No way. The genius of optimization just went 50-50.
Yes. And when they asked him why, he said, I visualized my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. My intention was to minimize my future regret.
That is incredible. Even the Nobel Prize winner prioritized his emotional state over the math. He was optimizing for regret minimization, not return maximization.
Precisely. And that's what we should all do. The sources also mention tailored rules. Rules that are specific to your own weird psychology.
Give me some examples. Like what?
For example, a rule like, I will never check my portfolio more than once a month.
Oh, that's hard to do.
It is, but that's a behavioral guardrail.
Yeah.
Or another one is keeping a small fun money sleeve.
Ooh, I like the fun money concept. Is that just gambling, basically?
Essentially, yes. It's acknowledging that you are human and you might have an urge to gamble or speculate on a hot stock or a crypto token.
Right.
If you suppress that urge completely, you might blow up your whole plan one day by betting the farm. So you take maybe 5% of your money and say, this is my Vegas fund.
If I lose it, whatever.
Right. If I lose it, fine. If I win, great. But it scratches the itch so you don't gamble the actual nest egg.
It's like scheduling a cheat meal on a diet. It keeps you on a diet long term.
Exactly. And auto investing is another huge one, taking the decision out of your hands entirely.
Right.
If you have to consciously decide to invest every single month, you'll hesitate when the news is bad. If it's automatic, you just keep buying.
The expert in the notes actually provides a litmus test for any financial plan. I think this is a great thing for you to ask yourself right now as you listen.
The test is really simple. Would you stick with this strategy during a 50% market drawdown?
50%.
Picture your account value cut literally in half. Picture the news headlines saying the economy is collapsing. Would you stick to the plan?
It's a tough question.
If the answer is no, or even if it's just, I don't know, then it doesn't matter how optimal the math is. The plan is too risky for you. You need to dial it back until the answer is a confident yes.
That is the ultimate reality check. It's not about beating the S&P 500 this year. It's about staying in the game for 50 years.
And that brings us right back to how these two big concepts actually fit together. Freedom over time is the goal. That is the destination. We want maximum life control.
And the reasonable plan is the vehicle.
Correct. You won't reach the destination if your strategy breaks down on the side of the road because it was too fragile.
Right.
A slightly less efficient but much more sustainable plan is actually the fastest path to freedom because it's the one you won't quit.
So in practice, this really means we choose savings and investment habits that build that time buffer. We prioritize flexibility. We might even actively choose a career that pays a little less but gives us our evenings back.
And we allow ourselves those technically inefficient choices like holding extra cash because they bring us closer to the days we actually want to live.
Yeah.
Success isn't, did I beat the market? Success is, can I increasingly decide how to spend my time on my terms?
It really is a complete reframing of the whole game. It takes the pressure off the performance and puts the focus squarely on lifestyle design. You're designing a life where you own your hours.
And you're doing it in a way your real, emotional, messy human self can actually maintain day to day. That is the true definition of a winning strategy.
I think that is the perfect place to land this deep dive. We've covered a ton of ground today, from the yacht fallacy and the man in the car paradox, all the way to the power of being reasonable over rational.
It's a lot to process.
It is. But before you go, I want to leave you with one final thought to really chew on. This wasn't explicitly in the notes, but it's a question that just naturally flows from everything we've been discussing.
What's the question?
If you looked at your current spending and saving right now today through the lens of purchasing time rather than purchasing things,
Okay.
what is the very first thing you would stop buying? And even more importantly, what is the very first freedom? Maybe it's taking every Friday afternoon off. Maybe it's firing a nightmare client. What is the first freedom you would buy instead?
That is definitely a question worth sitting with.
Thanks for listening to The Deep Dive. We'll catch you next time.